My dear students, today let us discuss about taxability of gift and securities. As per section 56, subsection 2, subsection 10 of Income Tax Act, gift received by an individual or Hindu undivided family in the form of money or property without consideration or with inadequate consideration is taxable as income under the head income from other sources. But there are certain situations where gift is not taxable. Gift received from relative, gift received under a will, gift received on the occasion of marriage of the individual, gift in contemplation of death of the giver, money or property received from local authority, money received from charitable institution registered under section 12AA. If an individual or HUF receives from any person or persons any gift exceeding rupees 50,000 in any previous year, as per income tax laws, the aggregate amount shall be taxable as income from other sources in the hands of individual or HUF under section 56. Now we have discussed there are certain situations where gift is not taxable. Such a situation is gift received from relative. As per Income Tax Act, the sum of money received from any of your relatives are fully exempted from tax. So, who are relatives according to income tax law? Spouse of the individual, brother or sister of the individual, brother or sister of the spouse of the individual, brother or sister of either of the parents of the individual, any lineal ascendant or descendant of the individual, any lineal ascendant or descendant of the spouse of the individual, spouse of the person referred in clause 2 and 6. Gift received from non-relatives. In this case, you are tax exempted up to maximum of rupees 50,000 for a financial year. If you receive money more than rupees 50,000, you are liable to pay tax on the aggregate amount. Then gift at the time of marriage. Any gift received from any person at the time of marriage is not liable to tax. There is no monetary limit attached to this exemption. Now let us discuss about the types of securities, chargeability of types of securities. So first, government securities. Securities issued either by central government or state government are government securities. No tax is deductible on government securities. The amount received or due, as the case may be, it will be added to the income. Here, interest on government securities will not be grossed up. The concept of grossing up, I will explain that in the next video. Okay, so remember one point, that is interest on tax-free government security. Okay, interest on tax-free government security is fully exempted from tax. Next one, tax-free commercial securities. Such securities are issued by companies. Actually, these securities are not tax-free. These securities are called tax-free, because it is from the point of view of investor and not from the point of view of company. The investor does not pay tax on the interest on such securities, but company will pay tax on interest on behalf of the investor from its own funds. But while computing the income of the investor, gross amount will be including in the income of the investor. Gross amount means interest received, whatever is the interest that we are receiving, that amount plus tax paid by the company to the government, that is called gross amount. That will be included in the income of the investor. Any tax paid by the company on interest income on behalf of assessee can be deducted from the total tax liability of assessee on final assessment. Okay? Any tax paid by company on interest income for assessee, that amount can be deducted from total tax liability of the assessee at the time of final assessment, and assessee needs to pay only the balance amount. Okay, next one, less tax commercial securities. All the securities other than tax-free securities are less tax securities. The word less tax means before making payment of interest, tax at a rate in force shall be deducted at the source, and that amount is deposited in the treasury on behalf of the investor. In the case of this type of security, that means less tax securities, income tax is deducted at the source on the amount of interest calculated at the specified rate stated on security, and the balance amount left after deduction of tax is only paid to the security holder. Okay, in case of less tax security, if interest received is given, then you have to gross up. If interest received is given, you have to gross up. Case 2, if rate of interest and amount of investment is given, then interest income can be calculated, which is not grossed up. Okay, this will be more clear when we do problems relating to this tax-free commercial securities and less tax commercial securities, and also we can discuss how to gross up and what is the meaning of grossing up of interest. Okay, hope that you understood today's session, and for detailed notes you can visit the blog also. Thank you.